Hello, everyone, and thank you for joining us today. My name is Kyle Bell, Knowledge Exchange Specialist with Farm Credit East. Before we get started, I'd like to offer a few technology tips to keep in mind while viewing today's webinar. All attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be a time for questions and answers at the end of the presentation. Questions can be text chatted in at any point during the presentation. To send in your question, click on the question mark button on the right side of your screen to expand the question box where you can type in your question. A recording of today's presentations will be available at farmcrediteast.com/webinars, as well as our YouTube channel for access after the presentation. Before we get started, just a simple disclaimer that all this information is presented in good faith and should not be intended to be investment, tax, or legal advice and should not be reapplied upon. Now I'll turn it over to our Farm Credit East specialists, Daria Rezzo and Austin Weaver.
Thank you, Kyle. Appreciate that. As Austin gets ready to share his screen here with the webinar, what we're going to talk about today is a really important requirement that over 30 million businesses in the country are going to have to file through the end of the year. And also, if you just kind of swap over your presenter mode there to kind of full screen it, we should be good to go. What our goal is today for Austin and I is to provide information and resources to allow customers who choose to file this reporting that we'll discuss to be able to do so in a compliant way. And Austin is going to get into the nitty-gritty of who's got to report, who's exempt, non-exempt, why this law exists, what the filing and timelines are for this, and we'll save room for Q&A, as Kyle mentioned at the end of the seminar today. A little bit of background on what's going on is this law passed a couple years back in some legislation, but it's effective right now. As we talk about BOI, or beneficial ownership interest reporting, this is all under the Corporate Transparency Act. And FinCEN, the Financial Crimes Enforcement Network, is the who behind it from a government perspective. And to get to the bottom of it, basically, the government is trying to ascertain who are behind these legal entities, right? If Austin and I are the members of the Farm LLC, they want us to file reporting, unless we're exempt, that we'll get into, letting the government know who the owners are, where they live, birth dates, identification numbers. And there's really good resources that I mentioned that we want to be able to provide you with if you choose to file these yourselves. You can see on the screen the FinCEN Small Entity Compliance Guide. If you just plug that into Google, a very nice PDF will pop up with some really great materials on there. Now, some customers may have situations where it may make sense to get legal advice, depending on the business structures. As we get into the program, you'll see how this can become very complicated. And also we'll get into also the severe penalties that could bestow somebody if they are not in compliance with what's going on. Because of some of those compliance issues with being legal in nature, Farm Credit East will not be preparing these filings for customers, as they're not really a tax filing per se, but we want to make sure that everybody knows exactly what the filing requirements are and what resources are available to them. From a legal landscape perspective, it's been a little bit of a hot potato. You can see that in some parts of the country, taxpayers have challenged this, and it's actually an injunction right now in the Northern District of Alabama. There's a few other lawsuits going on in Maine and some other places where the goal is to try to overturn this law. Time will tell if those are successful or not. There's also current legislation within Congress to either delay or repeal the law in its entirety. Those so far to date have been primarily partisan bills. Don't know where they'll go or not go. The main takeaway I would say is we should act as if this law is in effect, as if it will be here, and make sure that we understand our reporting obligations for 2024. So now at this point, Austin can get into some of the weeds of what this looks like for who has to file, what the requirements are, and what information you'll need to be compliant in this area. Austin?
Thanks, Dario. So one of the first things we have to understand is, what is a reporting company? And at the end of the day, this is at the core who will have to report and who's going to have to give the information. So reporting companies will fall into really only one of two buckets. Your first is a domestic reporting company. These are going to be entities that are formed in the United States as either a corporation, LLC, or otherwise filed using a document that was accepted by the Secretary of State. It will also apply to entities that have been formed with a tribal nation and their Secretary of State equivalent. We'll focus on domestic reporting companies today, as that should be the bulk of our customers in the agricultural base in the Northeast. But just so you're aware, foreign reporting companies are that other bucket. These would be legal entities that are registered to do business in the United States, but they are actually housed outside of the United States in a foreign country. Not every entity that meets the definition of being a reporting company will have to file a beneficial ownership information report. There's actually 23 specific exemptions. Most of these are by industry. Some are actually by facets of the business's operation. These exemptions largely apply to different types of entities or industries that already have heavy regulation. So things like banking, insurance, investment companies, those will be exempt because there's already government reporting and oversight that applies to them, and it has been that way. They won't necessarily be saddled with yet another layer of reporting. When we think about our agricultural operations, agriculture in and of itself will not be an exempt entity. However, there are still, 4 that we'll highlight today that could be applicable to our operations. The first would be a large operating company, Commodity Exchange Act registered entities, tax exempt entities, and potentially inactive entities. We'll go through each of these 4 just to get a little bit better understanding of, what would help you fit into that bucket of being exempt and not even needing to file anything with FinCEN under this regime. Large operating company first we'll look at. These tests are all and tests. So just because you meet one, that doesn't get you there. You'll have to meet all of these as we go through. So the entity must employ more than 20 full-time equivalent employees. For this purpose, a full-time equivalent is someone that performs 30 hours of service a week for your business. You also have to employ more than 20 in the United States. So theoretically, someone could have 20 full-time employees, but 15 work in Maine and 5 work in Canada. If that's your circumstances, you will not be exempt under this test. But if you have those 20 that are in the United States, you have to have a physical office in the United States. And then we have to look at some, tax or financial information. So for the year that you need to do this filing, we're going to look 1 year back. So if we're thinking about doing our filing before the end of 2024, we're going to look at a 2023 tax return. We have to demonstrate more than $5 million in gross receipts, and those, basically your $5 million has to come from the United States. So it's okay if you have 10 and 6 are in the United States and 4 are in Canada, that's okay. You just have to have those 5 million sourced in the United States, meeting the physical presence and the 20 full-time equivalents. If you can cross all those hurdles, you would be considered a large operating company and not required to report under this. Commodity Exchange Act registered entities. This is simply defined as being an entity that meets the definition under the Commodity Exchange Act, or it's an entity that is registered with a futures trading commission. And you could do any of those things that are generally considered to be, the core business of a commodity broker. Tax exempt entities really can fit, one of these 3 code sections. Our typical 501c charities, those will be exempt. 527 political organizations, or certain types of trust as described in section 4947A of the Internal Revenue Code. If you don't meet one of those 23 exemptions and we've determined you are a reporting company, you have to report. So this will be a catch-all for pretty much anything else. There's only 23 specific exemptions, and there's a whole lot of other types of industry and businesses that are out there. So if you are that reporting company, meaning you were created by filing a document with the Secretary of State or similar office, and you're not exempt, you will have to report. Keep in mind, the definition, that references corporations and LLCs is certainly not all encompassing. the all-encompassing phrase is that you're registered by filing that document. So general partnerships or even single member LLCs could all still be reporting companies that, if they don't meet that exemption, do have to file. Once you know you have to file, this is all about identifying those beneficial owners. So it is important to take a look into what makes someone a beneficial owner, so that way you know who to include and what information we'll have to gather. Control and ownership are the two criterion that are really going to determine if someone is a beneficial owner. They look at control as being someone that either directly or indirectly exercises substantial control. We'll look at what substantial control means here in a few slides. The ownership test is based on someone owning or controlling at least 25% of the ownership interest of your company. Keep in mind, there are businesses that not one single person will meet the 25%. That said, that is recognized, and it has been determined that there will still be at least one person who meets that substantial test, even if they are not a 25% owner. So if I have 10 people that each have 10% apiece, we still have to be able to identify at least one of them as our beneficial owner. Substantial control can really fit a couple different buckets. Many of these are really referencing kind of the corporate America world. So in agriculture, we don't always see these. We certainly do see some of them, but just keep in mind as we go through these, it's really facts and circumstances that support a role or position similar to what we're describing. So being a senior officer is an easy way to say that person has substantial control. So that could be a chief executive officer, chief operating officer, chief financial officer. It can be a person who has the authority to appoint or remove officers and/or directors of a company. Otherwise, an important decision maker. As you can see, some of these have a lot more gray area than others. So, how you define important decision maker may be different than the next person. But all of this really is a judgment call. If you have the ability to make decisions that others will rely on through going out your business, you most likely would be deemed to have substantial control of that entity. And then they leave this open-ended bullet point of any other form of substantial control. So whatever fits in your business, if you think you fit that, that's good enough for them. That'll get you across this definition. Ownership interests, in a way, are a lot more clear-cut. Ownership can be expressed, depending on your entity and tax type through the ownership of stock, voting rights, capital or profits interest, convertible interest, or any other mechanism that your reporting company utilizes to establish ownership. And again, we're looking for that 25% or more threshold. If no one meets it, then we really still have to look back to that substantial control to identify a beneficial owner. So once you know you have to report and who you might be reporting on, arguably one of the most important pieces of this, like any law, is understanding your obligation to file and the timeline for doing so. With most things, not understanding the law is generally not going to be an excuse. So this is a bit harder in that it really depends on where your entity's at in its life cycle. It will have different filing deadlines. So if we think about, on the left hand of the timeline here, if our entity was registered, effective, up and running on or before December 31st of 2023, we have a whole year to get this done. So if you've been around, your first filing is going to be due December 31st, 2024. If we form our entity during 2024, we really start to clamp down that timeline. We have 90 days from the creation or when we receive notice that our registration is effective to file that first report. Once we get to January 1st of 2025, we only have 30 days to become compliant. So we go all the way from a year down to 90 days, and eventually it'll be 30 days ongoing, barring any future changes. Those timelines are important because, as Dario alluded to earlier, the penalties can be quite severe. If you willfully fail to report complete or updated beneficial ownership information, you can be subject to either civil or criminal penalties. The civil penalties can go $500 per day that you continue to be in violation, and that can ramp up to criminal penalties of up to 2 years of imprisonment and or $10,000 in fines. Now, when we think about, an entity is the person that's subject to this, you can't go put Dario's LLC in prison, but the senior officers of that entity may be held accountable for that willful failure. Now, at the same time, you may be trying to do all the right things and get your report done for your entity, but maybe there is a beneficial owner you've identified that will not give you their information. We'll look at what that information is, but that person who does not permit an entity to have all the information to file a complete report is subject to these same penalties as if the entity itself did not file. So keep that in mind. This is a two-way street of the entity and the beneficial owner. And the penalties, as we've said, are quite pervasive if you're doing this willfully. So what do we have to report about each person? On the screen here, we've divided into what does the reporting company report about themselves, and what do we have to report about each beneficial owner. At the end of the day, these are largely similar. Obviously, there's certain things a person has that an entity doesn't, or vice versa. But both will have to report their full legal names. A company would also have to disclose any trade names that they're using, so any doing business as that they may have. The street address for the principal place of business, so essentially where you get your mail or where you might have said in your registration that service or notice has to be served to. The jurisdiction in which you're formed or registered, so this gets back to we're a reporting company because we've registered with the Secretary of State or the tribal equivalent. We want to know, which of the 50 states or however many tribal nations there are, where was that formation happening? And you'll have to report your taxpayer identification number, which for most entities, we would think about as an EIN. For each beneficial owner, we also have the full legal name requirement, their date of birth, their current residential street address, so a PO box will not suffice. This really has to be where you physically live. We'll have to give an identifying number from a non-expired government-issued photo ID, so that could be a passport or a driver's license. And again, we're going to have to tell them what state or nation issued that. And we also have to give them an image of that document. So it's not good enough to just copy the number down and send it in. If you look at the forms for reporting, you do actually have to upload your JPEG, PDF, whatever it may be, to show that this is the document that we are registering with. Some people may also have to identify a company applicant. So if we think about, we were at two buckets. We had the company and the beneficial owner. We may also have one or two company applicants, but never more than two. The good news is if we were created, on or after January 1st, 2024, we're required to report. However, if our entity existed prior to that, we will not have to bother with reporting anything about a company applicant. So what is a company applicant? It can fit one of these two buckets. It can either be the direct filer or the person who directed or controlled the filing. So when I say everyone will have at least one, the direct filer, if you're required to report it, you will have this. This is the person who filed your document that created the reporting company. So that may be an attorney. It may be yourself if you went ahead with the registration formation process in-house. You possibly have the second layer, the person who directed or controlled the filing. That would be who was primarily responsible for saying, hey, Mr. Attorney, go file this. It could be the case too of, you have an attorney and you have a paralegal. So if you're formed, basically within 2024 beyond, this is something you'll need to be concerned with. Probably one more reason of if we're going to file, create a new company, it may be best just to kind of do all this at once as part of that formation process with your legal agents. Now, FinCEN identifiers in a way are an alternative to what we've just talked about. However, it doesn't get you out of giving it at least once. So if you think about this, of if Daria and I are members of one LLC, but I'm also in an LLC with my brother and maybe another one with my mom, I don't necessarily want to have to give all my information to these three different people and make sure I get it all right and just worry about all that information being out of there. What I could do is I could go to FinCEN and say, hey, I would like to get a FinCEN identifier. I'll give you all my information once, and then you're going to spit back to me a number. and I'm going to use that number on these 3 beneficial ownership information reports. The nice thing about this too is, as we kind of, we'll walk through when do we have to update this. If I'm in more than one company and I move, I have to remember to go to all 3 of those companies and give them my new information. With a FinCEN identifier, I can still go back to just FinCEN, update my number, and then my number stays the same, but my underlying information has changed. So it will cut down on some of the redundancy or just the risk of, forgetting one report that may be out there. A reporting company, the individual owners and company applicants are all eligible to participate in this. I think, anecdotally, I would expect your company applicants may be the most apt. Generally, you don't go to your attorney and say, hey, can I get a copy of your passport? So this is one way that we can avoid some of that. And also, if you're just leery about giving it out, but you say, hey, I don't want to do 2 years in prison and $10,000 in penalties, this is your way to get the information to the government or to the law enforcement agency, but not necessarily have to give it out to these individuals that you interact with through your company ownership. Updated reports. So this is, we talked about that initial filings, where we either have a year, 90 days, or 30 days. Once we've made that initial filing, we're now under a 30-day timeline if we ever have to do an updated report. Updates are going to be required when there's a change to what I've previously reported about either the company or the beneficial owner. I will not have to file an updated BOI report if my company applicant information changes. Direct from that small business entity guide that Dario alluded to earlier, some examples of changes that really, these are not things that never happen. These are things that practically could be happening every year, especially if you have an entity with 3 or more people in it. A new name, whether that's you got married, to change your name any other way, you get a new physical residential address, just moving. If you have a new identifying document, so that driver's license expires, the number is different when you get it back. Same could be true for your passport. Any change in your beneficial owners. So if we are, a corporate structured entity and my CEO retires and I get a new one, I have to report that. If I have any sale or other ownership transfer that impacts that 25% threshold, that could change who the people are that I have to report on. Now, if we're all 25%, 4 people in a partnership, and one of us goes from 30 or goes to 30 and the other goes to 20, that's still a change because maybe that person that went to 20 now is no longer a beneficial owner if they were getting it just because of the ownership requirement. The death of a beneficial owner can also impact this. One nice little reprieve is that in the case of a death, the 30-day window starts when the estate's been settled. If we think about this, that's logical because the whole goal is that we're going to be able to determine who that actual living, breathing person underneath the ownership thing is. So if I have it in an estate that's not in and of itself a person, there may be, some fighting amongst heirs of who's going to get it. We get to sort all that out, get it to the person, and then they have 30 days to let the company do an updated report with their information now. So we've talked a lot about, what you're going to have to report, but where do you go file this thing? The Federal Crimes Enforcement Network, FinCEN, they have a direct website. It'll be linked here in the presentation. It brings you this nice little landing page, and they have it pretty simple. You just click the file BOIR, and it'll walk you through, basically fillable form of all the stuff that you got to put in there. To our knowledge, this is required to be filed online. There's not appear to be any option where, you could go pick up a copy of this at the library, like your tax forms, fill it out on paper and send it back to someone. It does appear this is an online filing for all people that are subject. So we did think it'd be appropriate to kind of walk you guys through an example. So presuming most people on this webinar today are, in the agricultural industry, we'll look at, what at one point may have been thought as a complex entity structure, but, I think Dario and I will tell you, we see this every day, even with relatively small companies. So what we're looking at here on the screen is the main operating entity owned by A, B, C, and D. They are operating the farm, running everything except for the real estate. So maybe it's a dairy farm, maybe it's an apple orchard. It doesn't really matter for purposes of the conversation. Partner A also has a single member LLC, and it just so happens that that LLC is providing nutrition services to the farm business. This operating entity is also renting land from two different entities. One is a real estate holding company owned by the same partner B, but B's spouse is a member of the real estate holding LLC. The operating entity is also renting from C and D, who for purposes of this illustration are the senior generation of the farm, but they own their real estate in a trust that are renting it back to the farm. So what we're going to do now is walk through, essentially the four entities on the screen and look at what criteria do we need to understand to determine if they are a reporting company and whether or not they have an exemption. So starting with the operating entity, it's a multi-member LLC, taxed as a partnership, and it certainly was created by filing with the Secretary of State. The farm employs a chief financial officer who is not an owner. So one of the first things we may look at, this is kind of the quick and dirty of, if we summarize the K1s from this entity, we can see that A and B each receive 50% of the profits. C and D receive 0. Let's assume that they're a retiring partner. They share losses the same way they share profits. And the current capital ownership of the business is A with 30%, B with 25%, C with 25%, and D with 20%. So the first thing we're thinking about, the quick answer is, well, if they have over 25%, they probably have significant ownership and they could be a beneficial owner. So that would have us at A, B, and C. Think about too, they have a CFO. That's a senior officer. That person would be deemed to have substantial control of the entity, even though they do not have ownership. But now we start to think about some of those exemptions. So on their 2023 tax return, this entity had $6.38 million of gross revenue, and they employed 23 full-time employees. So those things lead us to the conclusion that, yes, this is a domestic reporting company because it's filed with the Secretary of State, operates in the United States. However, they will be exempt from the beneficial ownership information filing because they're a large operating company. They've met the gross revenue test, they've met the full-time employment test, and we're going to assume that this only operates in the United States of America. So this entity would not have to file anything. It's not even like, let's put our information in and check a box that we're exempt. We're just purely exempt from that filing. Now let's switch gears and look at the first real estate holding company. This also is a multi-member LLC. And yes, it's a real LLC. It was created by filing with the Secretary of State. B and B's spouse split this thing 50-50 down the middle. Like many of our husband and wife businesses, that's how they report it. That's how they run it. They consider it, property of the marital unit. Yes, they each have their own 50% though. That could be telling us that, hey, they're both over 25%. Maybe they're both beneficial owners. Looking then to their gross revenue, they have $225,000 of rents annually on their 2023 tax return. They have no employees. This would be typical of your pure cash rental entity. This again is a domestic reporting company, but they're not exempt. This business does things. It's renting its land. It does not have $5 million of receipts. It does not have 20 full-time employees, and it's not a tax exempt entity. Therefore, B and B's spouse would both report as beneficial owners because they've crossed that 25% ownership threshold. Now looking at the real estate trust. C and D are the settlors of this irrevocable trust. So C and D have signed over the deeds of what previously was their property. It's now owned by the trust, and for all intents and purposes, they don't want to change that. C and D receive all the income from the trust during their life. This is typical, we see this in Medicaid planning or other estate planning, that we kind of gave the asset away, we're setting up for that post-mortem situation, but we're still going to get the cash to live on his retirement. A is the trustee of this trust. He doesn't own it today. We don't even necessarily know or care that he may be the beneficiary. He has the authority to distribute the trust principal, though, because C and D have given up their rights to it. So this may be a distribution, for a health, education, maintenance, support need of C and D, or for whatever reason, A can come in and kind of put that property to someone else. For the 2023 tax year, this entity received $175,000 in gross revenues, again, cash rent, and like most of our real estate companies, they have 0 full-time employees. This again is a domestic reporting company because trusts are created with the Secretary of State. We don't meet any exemptions based on really the same stuff we talked about with the other real estate LLC. But here, C and D are beneficial owners, but also A. If you have the authority or ability to distribute the principal of a trust, it's hard to make an argument you have no substantial control over that, because really the entity is predicated on what's in there. So this is a case where a non-owner would in fact be a beneficial owner for the purposes of these reporting requirements. Now let's look at a single member LLC. So by virtue of single member LLC, A is the sole member. He gets 100% of the income, owns 100% of the property. And this was created with a filing by the Secretary of State. So even though, for federal tax purposes, this may be disregarded, it does exist for state tax purposes or for state legal matters. In the 2023 tax year, assume this individual reports on a Schedule C, he showed $420,000 of gross revenue for this LLC, and he employed 2 full-time people. This again is a domestic reporting company. No exemption is met, but A is the only beneficial owner. So A would file just himself and his single member LLC on his reporting. So as you can see, in that example where we had a lot of different entities all working together, some of the key takeaways are this may be what we would view, or even technically would be a consolidated group of entities. They all work together, they all use the same financial people, they tax plan together, they do all of that. They're not necessarily all reporting companies. We have to go through the criteria for each company on its own merits to make that decision and ensure that we're filing the right reports. So, back to the case for a FinCEN identifier, A in this situation he's on 3 reports. He's on the trust, he's on a single member LLC, I guess he's only on 2. But in that case, he may want to just get that number so that way he doesn't cause either of these companies to have to go and completely redo their reports if he moves or gets married and changes his name or anything of that nature. I think at this point, we'll open it up for questions. On the screen is both my contact and Daria's contact information if anything needs to be taken offline.
Hey, Austin, there's a couple of questions that have come in so far. The first one was, will FinCEN tie in with login.gov? And the answer to that question, I think maybe getting at the FinCEN identifier. So if you do request an identifier from FinCEN, then you will need to create a login.gov account there. So there is some tie-in in that regard. The second question discussed, what about revocable trust? You mentioned irrevocable trusts. Is the same construct as well?
Yep, so they certainly could be. Again, we have to think about how is that entity formed? Generally, it is going to be formed still through the Secretary of State filing. When it comes to the beneficial owners, it's going to be facts and circumstances. I think, in our practice, we talk to people all the time about, we think there's 2 buckets of trust, revocable and irrevocable. That said, in a way that may be true, but the way that they function, who has different rights to those assets and the income can all be very different. So it would just be important to, go through that analysis based on your facts, circumstances, and really what's going to be in that governing instrument for that trust.
Thanks, Austin. Another question that's popped up, and I addressed at the beginning of the program, but Farm Credit East will not be filing these obligations for LLCs. What is the definition of an inactive LLC, Austin? That's the next question that's come down the pike here.
Yep, so inactive entities, essentially it is kind of what it sounds like. But really, I think the important criteria is that you have no bank transactions through it. So it's not enough just to say like, maybe one of these rental companies, it's a triple net lease, what comes in goes out. Not having net profit doesn't mean you're inactive. It really means you've conducted no business in the United States. And if anyone, did go through a bank account, there are no transactions in the last 12 months.
The next question says, do 1099s count towards the 20 employee level for a big company? So great question there, but remember, Austin mentioned employees are full-time equivalents, 30 hours a week, so contractors are not employees. So that's important to keep in mind, the distinction between who is an employee and who is a 1099 contractor for your business. If my tax preparer does not file this, who can help me? My attorney? Yes, definitely. You may want to seek out your attorney's advice, particularly if you have complex structures, figuring out who, as Austin mentioned, may be in substantial control of the business. Some of those become org chart related, HR related, and certainly having legal advice cannot hurt you to be compliant there, because remember, the fines here are pretty big, $10,000 at the tail end of it, and possibly imprisonment for some of the willful neglect stuff. You want to make sure these filings are accurate. The next question, yes, there will, another penalty question. There will be penalties for late filing. Austin mentioned $500 a day, is that right, Austin?
Yep, so for basically, think of the simple situation, I guess, could be your entity has existed for the past 20 years. Once we get to January 1st, 2025, it's $500 a day from that point on until you make your filing and become compliant.
If you are an exempt large company and then the next year your income drops below the thresholds, do you have to report in that following year?
Yes, so all of these tests, we have to be evaluating that on an annual basis. So, and I think practically speaking, that's why we're always referencing one tax year back. That makes it a little bit simpler. We're not predicting and then figuring out at the end of the year if we're right or wrong. So yes, if you're a large company this year, you do have to think about, are you the same large company under the definition for next year? So that's not necessarily an updated report. That would fall under the principle of, we just have to think about, do we report? It is an annual test.
Yeah, that's a great point, Austin. One of the hard parts about the BOI that we've been talking about the last 40 minutes here is sort of the constant monitoring of your status, whether it's you now are no longer exempt, whether something changed from initial filing. Being constantly monitoring that status is going to be critical to ensuring compliance in this arena. Yeah, we will provide examples here. So the question is discussing some of these examples that we've talked about. We do have blog posts out on farmcrediteast.com regarding this topic. We do plan to continually update that with additional information and materials, as well as examples there. Yeah, another question on trusts. Yeah, a lot of trust questions, Austin, here. So just again, I think the key is, as Austin pointed out, making sure when you have those unknown questions, and this is kind of where it morphs into some of these, they're kind of legal questions too. If somebody passes away, somebody dies, you probably are working with an attorney through that probate or estate process. And as attorneys get up to speed in this area as well, they should be aware of what is going on in this arena and be able to offer you sound advice during that estate probate period of time of which you are trying to figure out what's regarding to filing as far as your wills, any trust documents, any BOI updates, transferring title to things. This will become another part of the totality of wrapping up estates, particularly if trusts are created during that time. So great question there. Question, Austin, on FTEs. Can you explain how this figures for seasonal employees? Probably deals with that hourly threshold, I would assume, right?
Yeah, so it's defined pretty basic in this in this world, at least from the FinCEN guidance that's been put out there, but it is in a way annualized. So it's looking at 30 hours of service per week on an annual basis. So, you know, I guess I don't specifically know the calculation for the seasonal, but we can look into that and put more guidance out there as we kind of flush that out.
Couple of questions on the portal. Yes, the portal is ready to start filing as of today. Some companies have already filed this at this point in the year. I think I mentioned at the beginning of the program, about 36 million businesses are supposed to be filing this through the end of the year as it currently stands, assuming the law remains in effect, which, you know, we should make that assumption. You can go do this today, right? These are open. You can go on FinCEN and file this, and it should be, IRS estimates on your typical company, maybe an hour and a half at the higher level. If you're a very basic mom and pop, husband, wife, 50-50 LLC, that's all you got going on, probably wouldn't take more than a half an hour, if that, to kind of get logged in and get your filings all squared away.
I think the hardest part is just getting the information. You know, the filing itself, it looks like any other website.
Yeah. Question is, do these reports have to be filed every year? I think I know where you're going to say. You're awesome. Why don't you give the
Yep. So
there.
There is a chance that this is a once and done. So if you do your report and nothing ever changes, no, you don't have to do it annually. The only time, you know, I wouldn't say it's prescribed annually. It's more the fact of, do we now have to file and we never did, or did something change and now I'm on that 30-day clock for a change? If nothing changes, you never move, your driver's license never expires, you never get married, divorced, then yeah, it could be done. But it seems unlikely that many people would have a once and done filing.
Yeah, I agree, Austin, particularly with thinking of farm families and, you know, bringing in the next generation into the businesses, people moving, relocating, documents expiring. It probably is the exception that you will be one and done filing as far as this goes for the duration of however long this is in effect for, which is at this point in perpetuity.
Yep.
If an LLC is required to file, will the requirements for future filings be eliminated if the LLC is dissolved and activity ceases? I think that kind of gets into your point, Austin, on inactivity for LLCs. Is that right?
Yep. And if you've dissolved, then you don't exist. You're no longer a reporting company.
If I own a holding company and am the only beneficial owner and is a beneficial owner of another company, if I as a person report, okay, so this, let me simplify this question also. It sounds like they're asking for tiered reporting of companies, how that would work. So would you report if I have one LLC that owns another part of another LLC that's a beneficial owner? I assume there's reporting at both ends, and does it go through looking at the people behind that second LLC?
That is my understanding. In the guidance that, you know, there's a lot about this in the trust arena of, you know, it's not uncommon to have your business interest owned by a trust. The beneficial owner is going to be a person.
Is there a fee to file?
If you do it direct through FinCEN, no. Obviously, you know, whatever third-party professional you use, that's at their discretion. But to go and do this all on your own, it is free.
Those are all the questions that have come through for now, Austin. I think we have answered them all. Kyle, unless there's any other questions that have come through, do you see anything on your end?
Nope.
Okay, great. Well, thank you everybody for joining us today. I believe, Kyle, correct me if I'm wrong, this information will be recorded and out there to view at a later time as well. If you have any questions, feel free to get a hold of Austin Weaver here, and check out our website at farmcrediteast.com, our tax talks, for updated information as this progresses along. We'll keep having future posts that discuss this topic and any information that's relevant that you need to know as it transpires here. Have a great day, everybody, and enjoy lunch.